Welcome. In this video, I am analyzing Bosch Ltd. This is a company in auto ancillaries. Its current price is 13,126 rupees per share, and the results are up to date till December 2019. The sales in the latest quarter of December 2019 was 2,500 crores, and in the preceding year of the quarter, that is December 2018, was 3,000 crores. So we see a 15% drop in YOY quarterly sales growth. Whereas if we see YOY quarterly profit growth, it has increased to 12%. Although in the preceding quarter, it had a 335 crores of net profit compared to 190 crores in the latest quarter. Though this has seen a drop from the previous year's quarter, the reason why this is showing as positive is because this 335 crores in the previous quarter had an extraordinary gain which has been removed. So the YOY profit growth rate is the adjusted growth rate. Next, let us look at the sales of 2019 and compare that with the sales of the recent 12 months. So we see a reduction in the total sales or revenue generated from 12,000 to 10,000 crores in the recent 12 months. So the sales has definitely dropped by around 2,000 crores. Compare that with the profit, which has also fallen from 1,500 crores to 1,250 crores in the recent 12 months. 1,597 crores is the profit earned in 2019. When we compare the cash coming in against the profits of the company in the last year, that is 2019, we see that almost half of the profit was received in cash. And what I generally look for is that the cash has to be as much equal to profit that the company has earned or more than the profit declared by the company. The stock is down by around 32% from its 52 weeks high, that is wherever the stock was in the last 1 year, the highest point it had reached. From there it has fallen 32%. Historically it has been trading at a price to earnings multiple of around 39.8 times, whereas the recent price earning has come below its average to 30.9 times. So this has become quite cheap when compared to its averages. Now when we look at price to cash flow, it is quite high at 63 times its cash earnings, which we already saw earlier here, that the cash coming in through operations was just 605 crores against the profits of 1597 crores, which is like almost half of it. Similarly, in price to cash flow and price to earnings, we can see the similar ratio of 30 price to earning and 63 price to cash. So this is what is indicating in terms of valuations as to where the price is according to the cash earned by the company through operating activities and earnings, that is profit, net profit earned, and comparing that with the price we are paying for each share. When we look at price to book value, that too is quite high at 4.23 times, although it must have fallen from a higher value to 4.23 because we see quite a fall from its 52 weeks high. Next, let us look at the price earning to profit growth rate ratio. This has to be below 1.5. We have to compare the price earning that we are paying for Bosch, that is 30 times, and compare that with the profit growth of the last 5 years and profit growth of the last 3 years. So when we say price to earning, it means what is the multiple or how many times more we are paying for the earnings or against the earnings of the company. So here we are paying 30 times more than the profit earned on each share, and that profit over the period of last 5 years has been growing at 13%. So we want it to grow as high as possible because we are also paying a high price to earnings multiple. but in the recent 3 years the profit growth has slowed down to 5.46. Therefore the PEG also has increased to 5.6. So here we want the PEG to be at least 1.5 or below. Even if you have to pay a high price to earnings, it does not matter if the profits are growing at a healthy pace or a high rate. We can look at sales growth of last 5 and 3 years, that is in single digits. Since last 5 years the sales has been growing at 6.96%, and in the recent 3 years the growth rate in sales has picked up to 8.1%. So these are good values in terms of sales, although anything above 10 is recommended. ROE, return on equity, that is what is the profit or net profit earned on shareholders' money, is around 16.7% in 2019. Comparing that with the average of the 5 and 3 years, we see it is almost nearby to its averages. Return on capital employed is around 24%. Again, it is very near to where it was in its 5 and 3 years average. So these values are in line with its averages. Let us look at return on assets. Return on assets, that is what is the total assets owned by the company, and against that what is the profit it is earning. So here it's 16%, and over the last 5 years on average basis it was earning around 16.24%. So again all the recent return ratios are nearby its averages. The company's sales were around 1.34 times more than its assets. So here we want it to be as high as possible, so that when we compare the sales against the assets owned by the company, we want the company to do as much higher sales as possible against the assets. So this is the asset turnover ratio. Similarly, we can also look at inventory turnover ratio, where we compare the company's inventory holding, that is how much inventory it was holding at the end of the year and how much sales it did in 2019. So this ratio too should be as high as possible, or around its averages of where it was 3 years back. So around 3 years back it was converting inventory into sales at 8.8 times more, and in 2019 the inventory was converted 9.18 times into sales. The profit after tax of the last 5 years was 7,391 crores total, against which the company's operating cash flow of the last 5 years in total was 6,500 crores. The cash coming in through operations is slightly less than the profits declared, although in 2019 the cash, as we saw earlier, was almost half of the profits. But when we look at the long-term picture of the profits with the operating cash flow, we see that the cash has come in or is almost near to its profit that the company has declared. When we compare how much was invested in fixed assets from this cash that the company has earned over the last 5 years, we see that it has invested almost 40 to 50% of its cash in fixed assets, which is a decent percentage, because we don't want the company to invest a lot of its cash earned through operations into fixed assets, as that would mean that very little would be left over to put it into financing activity like paying dividend or doing buyback and bonus. So we want the company to have as much free cash flow as possible over the long term period. On an average basis, the company's profit every year has been at around 1,478 crores. The company's market cap is 38,700 crores. This is the value of the company in the market as of today. Comparing the market cap against the net worth of the company, we see that it is at 9,143 crores. So this is the price to book ratio that we saw earlier of around 4 times. That is, the company's market, the value in the market was around 4 times more than its actual value or its actual net worth. When we look at the contingent liability, these are the liabilities that may or may not arise in the future, and these liabilities are not accounted for in the balance sheet. So therefore we don't want to have a very high contingent liability against the net worth of the company. So this we have to keep in mind, that the contingent liability should not exceed 20% of the net worth. The company is debt free, therefore its coverage is very high. That is, because it doesn't have to pay any interest, whatever EBIT it is earning is going into net profit. Promoters are holding around 70% in the company, and no promoters' shares have been pledged, so this is a good thing. The debtors to sales ratio is also very low at 13%, which is a good value because we don't want it to exceed more than 30%. The debtors to sales ratio basically tells us what is the payment the company has to collect against the sales of 2019. So here we don't want a lot of payment pending to be collected against the sales of the current year. Company is collecting payment from its customers within 46 days. So this is a good value. It should not exceed more than 90 days. The net profit margin in 2019 was around 13%. Anything above 10% should be considered good. And finally, the company's dividend yield, that is how much dividend it is paying in terms of percentage against the current price, is standing at less than 1%. So this concludes my basic analysis of Bosch. The company has two major business divisions, that is automotive technology and non-automotive technology. The non-automotive technology includes industrial, consumer and energy and building technology.